I want to start off today with a question that, honestly, it seems to just defy all basic financial logic.
Oh, I know exactly where this is going.
Right. Because Netflix just posted absolute record revenue. I mean, they completely smashed their earnings per share estimates.
Yeah, it was a massive headline-grabbing earnings beat, the kind of thing that usually has Wall Street popping champagne.
Exactly. So why is the stock currently in this uh, terrifying nosedive? I mean, it is flashing strong sell signals across the board.
It really is a bloodbath right now.
Yeah, what makes it crazier is that Wall Street analysts are practically screaming from the rooftops that it's fundamentally undervalued.
Mm-hmm.
So what is going on?
Well, it's basically the ultimate market contradiction, And it's the exact thing that traps retail investors every single quarter.
Because they just look at the headlines.
Exactly. You look at the headline numbers and the algorithmic trading systems, they initially react like it's a gold mine. But then the human element kicks in.
Right, you look at the actual price action.
Yeah, and you realize the smart money is aggressively running for the exits.
Well, before we get into the heavy stuff, just a quick reminder for everyone listening, please make sure to like the video and subscribe to our YouTube channel.
Yeah, and leaving comments and feedback is, well, we're calling it compulsory today.
It really is compulsory.
Yeah.
If you want us to keep putting together these in-depth market breakdowns, you've got to let us know.
Absolutely.
So, let's set the stage. Today is Monday, April 20, 2026. And our mission for this deep dive is to unpack this exact Netflix paradox.
Right, because as we sit here right now, the stock is just getting hammered. It's sitting at $94.83.
Down over 8% in the last month alone, which is just wild for a stock with record earnings.
Yeah, and we're going to look at everything our sources have given us, right? The income statements, the underlying order flow, the, frankly, bizarre insider selling data.
To figure out if this is, a gallon buying opportunity or just a classic retail trap waiting to crush the average investor.
But really quickly, before we tear into the balance sheets, let's just establish the ground rules for the listener. What we are doing here is a natural analytical debate based on the data in our sources.
Right. We're just looking at the technicals and the fundamentals to understand the market mechanics.
Exactly. This is strictly an analytical discussion. It is not financial advice.
Definitely not financial advice.
We're just here to connect the dots on how institutional money moves. We are not telling you what to do with your own portfolio.
So let's get right into the mechanics of what I'm calling the earnings illusion. Because honestly, to understand why a stock with quote-unquote record earnings is plummeting, you really have to look under the hood of their Q1 2026 income statement.
Yeah, you really do. Because if you look at the top line numbers in a vacuum, they're staggering.
I mean, Q1 2026 saw $12.25 billion in revenue. That is a massive sequential step up.
Especially considering their entire annual revenue for 2025 was what, $45.27 billion?
$45.27 billion. And the net income for this quarter hit a whopping $5.28 billion.
Yielding an earnings per share of $1.23.
Right. And if you stop reading there, I mean, you just buy the stock.
Oh, absolutely. And then you look at the balance sheet. They are sitting on $55.6 billion in total assets.
Against, let's see here, $28.98 billion in total liabilities.
Right. So in a normal market environment, a balance sheet that heavy acts like a shock absorber, it signals stability.
But today, it's doing absolutely nothing to stop the bleeding.
Which tells us investors are not looking at what Netflix owns. They are terrified of what Netflix is actively doing with its cash.
Which brings us to the twist, right? The actual quality of those earnings. Because I was digging into that $5.28 billion in net income, and it turns out that massive EPS beat is almost entirely artificial.
Yeah, it is incredibly noisy once you strip it back.
It includes a one-time $2.8 billion termination fee from a failed deal with Warner Bros. Discovery.
So over half of their quarterly net income came from a corporate deal falling apart?
Exactly. Not from actual people paying for streaming subscriptions.
It's a classic accounting optical illusion.
I love that phrase. Accounting optical illusion.
Well, it's true. Because when institutional analysts strip out that $2.8 billion fee to see what the core streaming business is actually generating, the growth story completely changes.
Wait, so what did Netflix actually do with that cash?
They took that massive one-time cash windfall and used it to mathematically raise their full-year 2026 free cash flow guidance. They bumped it from $11 billion up to $12.5 billion.
That feels incredibly deceptive. I mean, especially if you're a retail trader just reading a push notification on your phone.
Oh, it absolutely is.
It's like, okay, think about it like this. It's like bragging to your friends about a massive bump in your monthly paycheck, acting like you got a huge promotion at work.
Right.
But you conveniently forget to mention that the extra cash was just an insurance payout because someone rear-ended your car.
That is a perfect analogy.
It's not recurring income. You cannot build a long-term business model on just getting rear-ended every month.
Exactly. And the smart money understands that distinction immediately. They strip away the noise of the insurance payout, as you said, and they look at the actual trajectory of the recurring revenue.
And what do they find?
They found the real catalyst for this massive sell-off. Netflix issued really weak Q2 revenue guidance.
Oh, a week.
They're projecting $12.57 billion, which completely missed the broader market estimate of $12.64 billion.
Wow. So operational growth is actively slowing down?
Yes, and they dropped this guidance miss at the exact same time they announced that co-founder Reed Hastings is exiting the board in June.
Talk about a double whammy.
Right. You combine slowing operational growth with the permanent departure of the company's foundational architect and...
Well, that one-time Warner Bros. Payout suddenly feels like a smokescreen.
Exactly. It's hiding a much deeper structural problem. The market's reaction wasn't just a brief dip. It was a fundamental repricing of the company's future.
So if Wall Street knows that earnings beat was just a one-time paper trick, it completely changes how we should read the current technical sell-off.
It does. This isn't just a broader market pullback dragging Netflix down.
No, the order flow shows active, aggressive human distribution. Let's look at the chart because honestly, it is a bloodbath.
It really is ugly.
The stock is trapped in a falling channel following this post-earnings gap down. I mean, it dropped 2.55% today alone.
And it's trading far below its moving averages.
Yeah, below the 5-day, the 10-day, the 20-day, and that crucial 200-day moving average. Plus, the MECD is sitting at a negative 2.51, completely confirming the downward momentum.
The relationship to that 200-day moving average is really the mechanism we need to focus on here.
Why is that one so important?
Because trading below the 200-day isn't just some technical glitch on a screen. It represents human psychology. It means that essentially every single person or institution who bought Netflix over the last 8 to 10 months is currently holding a losing ticket.
Oh, wow. So they're all in the red.
Exactly.
Yeah.
And that creates a massive wall of overhead supply.
Right, because every time the stock tries to take a breath and tick upward, someone who has been bleeding money for months just sells their position.
Yes, just to break even and get the heck out of the trade.
And that overhead supply is what creates that falling channel we were talking about.
Precisely. And if you look at the 52-week range, it paints a picture of extreme volatility. The low was $75.01 and the high was $134.12.
So at $94.83, it is hovering dangerously close to immediate structural support.
Yeah, our sources peg that support zone between $93.50 and $95.
And if the selling pressure breaks that $93.50,
there is very little historical buying interest to keep it from drifting all the way back down into the 80s. Major resistance on the upside sits at the $100 psychological barrier and then up at $107.
Okay, but I have to challenge this purely bearish narrative for a second here.
Go for it.
Because the technical indicators are flashing a massive contradiction of their own. I am looking at the RSI, the Relative Strength Index, and it is currently sitting around 26.7 to 27.3.
Ah, yes, the RSI.
And by every traditional metric, an RSI under 30 is officially oversold. Doesn't that indicate the selling pressure has just exhausted itself? Like, isn't a bounce basically guaranteed? Or is this just a dead cat bounce?
That interpretation of the RSI is where so many traders get completely trapped.
Really? How so?
Well, they view an oversold RSI as a guaranteed bounce, like a stretched rubber band that has to snap back. But a much better way to think about an RSI of 26 is to imagine a room where almost everyone who wanted to sell has already panicked and run out the door.
Okay, so the room is mostly empty of sellers.
Yes, but the question isn't whether the room is empty. The question is whether the building is on fire.
Oh, man. That is a great way to put it.
Right. If the structural issues, like the slowing growth and Reed Hastings leaving, are the fire, then it doesn't matter if the sellers are temporarily exhausted. The building is still burning.
Wow. So the heavy selling order flow post-earnings is just dominating the tape right now.
Precisely. An oversold RSI suggests we might see a brief tactical bounce for day traders, sure. but it does not indicate a reversal of the broader short-term weakness.
Because you just cannot fight the tape when large institutions are aggressively unwinding their positions due to those structural fears.
Exactly.
Which brings us to, honestly, the absolute wildest part of this entire deep dive. I'm calling it the smart money paradox.
Oh, the insider data, yes.
Because if the technicals are flashing oversold but the building is on fire, it begs the question of who is actually stepping in to buy at these levels and who is heading for the exits.
And the data from our sources reveals a glaring, almost absurd contradiction between the people running the company and the people analyzing it on Wall Street.
It's insane. Let's look at the insiders first.
The insiders are fleeing. There is really no other way to frame it.
Our sources show deeply bearish insider sentiment. They actually gave Netflix a strong negative insider power score of negative 89.39.
That is exceptionally low.
It is. Over the last 12 months, insiders have sold roughly $655.42 million worth of stock.
Over $500 million of insider distribution.
And wait, it gets worse. What's the number of insider buys? 0. Literally 0. Not a single executive stepped in to buy the dip.
The sheer volume of selling is notable, but you're right, the lack of offsetting purchases is the real red flag.
But the specific timing and pricing of these sales is what would keep me up at night if I were holding this stock.
Let's hear the numbers.
CEO Gregory Peters sold shares in the $82 to $84 range back in February, and Reed Hastings himself proposed and executed multiple sales around that exact same time.
So they looked at their own company with access to every internal metric in the world and decided $84 was a fantastic price to cash out.
Yes. Yet today, the stock is hovering around $95.
When the CEO and the departing founder are aggressively liquidating shares $10 below the current market price, it signals a profound lack of confidence in near-term upside.
They clearly believe the stock was fully valued, or maybe even significantly overvalued, down in the ADRs.
Right. They are managing immediate risk because they see the daily subscriber churn and the ballooning production budgets firsthand.
But then you look at Wall Street, and I swear they are living in a completely different universe.
The analyst data is pretty wild.
Out of the 34 to 51 analysts tracked in our sources, about 85% rate Netflix a buy or a strong buy.
And how many recommend to sell?
0%. Not one single analyst. The average price target is sitting between 114 and 115.
The institutional herd mentality is just incredibly strong here.
And it gets even crazier. I found the absolute wildest outlier in the data. An analyst firm called ATAL BBA actually has a price target of $1,514 on this stock.
Wait, really? $1,514?
Yes. Meanwhile, Rosenblatt is all the way down at the bottom with a $95 target.
That is just a massive spread.
So why on earth is Wall Street shouting buy and projecting these massive targets while the very executives running the company are quietly cashing out $500 million?
Well, the disconnect comes down to how these two groups assess time horizons and really how they construct their models.
Okay, break that down for us.
Wall Street analysts build long-term discounted cash flow models. They're looking 3, 5, maybe even 10 years out.
Right, they're not looking at next week.
Exactly. They plug in aggressive assumptions about global subscriber growth, ad revenue scaling, and long-term margin expansion. If the math in their spreadsheet dictates the company will generate a massive cash flow in 2030, the model spits out a buy rating today.
Regardless of the immediate chaos happening right now.
Exactly. They're completely isolated from the day-to-day friction of running the business. An analyst doesn't have to worry about a writer's strike or a failed marketing campaign. They just tweak a variable in Excel.
That makes a lot of sense.
Furthermore, there is massive career risk for an analyst to downgrade a legacy tech darling like Netflix to a sell.
Well, because if they're wrong, they look terrible.
Right. It is much safer to maintain a buy rating and just slowly lower the price target over time than to issue a bold sell and risk being wrong if the stock violently rallies.
But insiders don't have that luxury. Their actual net worth is on the line.
Exactly. The scale of this selling, combined with zero buying on the dip, strongly suggests that the executives see immediate structural headwinds that the Wall Street spreadsheets are completely ignoring.
So with insiders dumping and analysts hyping, the retail investors, you listening to this right now, you are caught right in the crossfire.
It's a tough spot to be in.
We really need to weigh the bull and bear arguments presented in our sources to see if this is truly an undervalued play or if it's just a classic value trap. Let's start with the trap. What is the structural bear case?
Well, the bear case argues that retail traders are about to get crushed because they are treating Netflix like a high-growth tech company, when in reality it is facing the constraints of a mature utility.
What do you mean by utility?
First off, subscriber penetration in the United States has basically hit a hard ceiling. Almost everyone who wants a Netflix account already has one.
Or they were sharing one, which the company has aggressively cracked down on.
Right. So future growth has to come from international markets, which inherently carry much lower profit margins.
Because a subscription in India simply doesn't generate the same revenue as a premium subscription in New York.
Exactly. But the servers and the bandwidth cost the exact same to maintain.
That's a huge problem for margins.
It is. But the more pressing issue is the content spend. They have $20 billion in front-loaded content costs.
20 billion.
Yes, and this is where streaming economics drastically differ from legacy media. A traditional network could film a sitcom, put it on television, and then syndicate it for decades, generating pure profit.
Right, like Friends or The Office.
Exactly. But Netflix has to pay massive sums of money up front to produce entire seasons of shows, burning through cash immediately, just to prevent their existing subscribers from canceling.
It's like an endless treadmill of capital expenditure that is actively crushing their near-term operating margins.
And the final pillar of the bear case is the leadership void. Reed Hastings is the visionary who dragged the entire entertainment industry into the digital age.
And his departure creates a vacuum at the exact moment the streaming wars have become utterly cutthroat.
The bears argue that without Hastings to navigate this saturated market, that $20 billion content spend is going to spiral, and the technical breakdown we are seeing right now is just the first leg down.
Down toward those $80 levels where the insiders were selling.
Precisely.
That is a genuinely terrifying outlook. But I have to push back with the bull case because the sources do give us some incredibly strong counter-arguments regarding their new business model.
Let's hear the bull side.
Bulls are looking at a price-to-earnings ratio of around 30x, coupled with 12 to 14% revenue growth. And they are arguing that the stock is actually quite reasonably valued for the first time in its history.
And the core of that optimism is the advertising pivot, right?
Exactly. The ad-supported tier fundamentally changes their unit economics. It's no longer just about how many $15 subscriptions they can sell. It's about how effectively they can monetize human attention.
Which is a much more scalable model if done right.
And by all accounts in the data, it is a massive runaway success. Over 60% of their new signups are opting for the ad-supported plan.
That is an entirely new revenue stream that didn't even exist a few years ago.
Right. Plus, they possess immense pricing power. The sources project that expected subscription price hikes in the second half of 2026 are going to push their operating margins to a highly efficient 31.5%.
That's a solid margin, and if they can successfully implement those price hikes without triggering a mass exodus of subscribers, all that extra revenue drops straight to the bottom line.
So the debate between the bulls and the bears really hinges entirely on execution.
It really does. The best-case recovery scenario is that the ad tier fully scales up, it offsets the plateauing U.S. subscriptions, and the new leadership team proves they can manage that $20 billion content budget efficiently.
And if they pull that off, a $94 stock price is going to look like the steal of the decade in retrospect.
Definitely.
So as we look to synthesize all this data for the listener, how do we break down the timeline? Like, what happens next?
We really have to view this through two distinct horizons. In the short term, meaning the next few days to weeks, the weakness is highly likely to continue.
Because the market is still digesting that guidance miss.
Exactly. The market is still actively digesting that Q2 guidance miss, and the institutional algorithms are still repricing the stock because that earnings beat was so heavily reliant on that one-time termination fee.
Plus, the underlying order flow is still heavily bearish.
Right. Until we see a strong, sustained base form around that $93.50 support level, the path of least resistance is downward. The building is still smoking, as we said earlier.
But the medium to long-term outlook is where the narrative shifts, right?
It does. The medium to long term pivots to a bullish stance, but with a massive caveat. It is only bullish if Netflix can hit its highly ambitious $3 billion advertising revenue target for 2026.
So it all comes down to the ads.
Yes. If they prove the ad model is a reliable cash cow that can subsidize their massive content costs, Wall Street's $115 average price target starts to look very realistic.
And that Ital BBA fever dream of $5,504 doesn't seem quite as detached from reality. Well, maybe still a little detached.
Maybe a little, yeah. But management has to prove it first.
It is the ultimate show me story for the market right now. The spreadsheets say buy, but the insiders say wait.
which is why you have to look at the data yourself.
Absolutely. And again, to everyone listening, I want to reiterate that this has been an analytical deep dive into the sources, the financials, and the market mechanics. This is not financial advice.
We just want to give you the context.
Exactly. Our goal is to provide you with the underlying context behind the flashing red and green numbers on your screen so you can formulate your own educated thesis.
Because understanding the why behind the price action is really the only way to avoid becoming exit liquidity for institutional sellers.
Perfectly said. And as we sign off today, I want to leave you with a final provocative thought to mull over.
I love a good cliffhanger.
We spent a lot of time analyzing the numbers, but the most important variable might actually be the human one. We talked about Reed Hastings completely stepping away from the board this coming June.
The end of an era.
Truly. He was the guy who mailed DVDs in red envelopes and somehow convinced the entire world to stream movies through the internet instead. I mean, he had the vision to disrupt an entrenched century-old industry.
It was revolutionary.
It was. So the question you have to ask yourself as an investor is this. With Hastings entirely removed from the equation, does Netflix still possess that original disruptive visionary DNA required to navigate a fully saturated cutthroat streaming market?
Or
Or are we witnessing the exact moment a revolutionary tech innovator permanently morphs into a slow-growth legacy media utility?
that is the multi-billion-dollar question.
Think about that. We will see you on the next Deep Dives.